Hey folks, I'm Clayton Collins, the CEO at HW Media. And today I have the pleasure of interviewing Vikas Gupta, the CEO of Azibo. And we're going to talk about the rental market. We're talking about rental data, the information that Vikas and his team at Azibo are seeing through their platform, which provides financial services and property management solutions to single family rental and rental property homeowners. So the really cool part about that is they're actually seeing transactions which gives them a glimpse into the health of the renter and some data we don't get to see in many places. This episode gives us a lot of information about building a technology, software, and financial services solution in the housing industry, but also some of the incredible insights that you're able to gain from a software platform in the housing sector that helps us better understand the health of the market. I hope you enjoyed today's episode with Vikas Gupta. All right, Vikas, wonderful to have you on Housing News. Thanks for joining me today.
Thanks for having me, and I'm looking forward to this.
Yeah, nice to meet you. And I have to say, when we were introduced and I started doing some research on you and your business, Azibo, I noticed that Gregor Watson's a co-founder, and I've had the pleasure of meeting him and getting to know him through the Gary Beasley and the Roofstock team. I actually met him initially at the Roofstock Dallas grand opening of their office years ago. It's a distinct memory for me. But I'm excited. I'm excited to hear the story, where Gregor fits and the founding story at Azibo.
Yeah, no, happy to tell you. So I'm not the founder, but I'll tell you the founding story, and then I can tell you how I got involved because that's also an interesting story.
Yeah.
So Gregor's a great guy. And so the three founders of Azibo are Gregor, Rob Blumker, who's his partner at One Sharp, and then our founding CEO, Chris Shu. And the three of them had this idea that there's an opportunity back in 2018 to build a modern property management financial services company for what has traditionally been an underserved market. So the independent real estate investor in the United States. And our founding CEO, Chris Shu, is the prototypical Azibo customer, right? He has a full-time job. He has about 15 to 20 units of investment property real estate. It's in a bunch of different cities. He self-manages, and he's trying to make that all work while also having a family and a full-time job. Now, from his background, he was in the Army, then he started buying property. Then he worked a series of very high-profile corporate consulting, private equity jobs. Like, he's a spreadsheet ninja. So he was doing all this in Excel, and he thought, all right, why do I need to basically build my own software in Excel? Like, there should actually be software for this. And so came Azibo. And so we are a unified property management financial services platform for independent real estate investors in the United States. So not only do we provide property management software, but also modern financial services, financial tools that traditionally have not been available or accessible to this class of investor and have traditionally only been accessible to large institutional owners, operators, and property managers.
Okay. So unified property management software and financial services solutions. That's a big big problem to solve and a big product area to operate in.
Mm-hmm.
So talk about where Azibo kind of starts and stops as a solution for owner operators of these kind of small to medium sized portfolios of rental assets.
So we started, and our core as a company is financial services, is rent collection, banking, and a suite, automated rent collection. And that may not sound all that fancy, but when you get sort of into the specific nuances of what that means for this specific type of investor, that could be support for multiple legal entities within one account. It's multiple different bank accounts because they often have one bank account per
Yeah.
property, or at least one bank account per legal entity. It's automated notifications, it's automated late fees, it's the support to manage leases with multiple different terms so that you're not keeping a list of when different tenants and when their rent payments are due and checking them off and texting them yourself and chasing it all down yourself. And then from a accessibility of financial services, in a traditional check-based world, like, you collected checks. No one wants to write checks anymore. Like, talk to anyone under the age of 40 or maybe even 50. Like, who wants to write a check anymore? They may have never even written a check before, but still 75% of rent's on check. So get away from check, ACH or card, debit or credit cards. So multiple payment options, and then integrated renters insurance. And we've launched a credit boost product that's seeing a lot of adoption by tenants. Again, that's a product that traditionally was only available through institutional property management software. And now this class, which is half the housing stock in the United States, these tenants have the ability to build their credit by paying their rent on time. It's a huge, huge value add for them. So that's I sort of like crossed a bunch of things just talking about rent collection, but that's sort of what we mean by like combining the property management tooling with the financial services. Then we have integrated banking. Our customers can either link third-party bank accounts or they can use the bank account that we offer, or a combination of both. The advantage of using our bank account is it's easy to open, so you can easily set up that like streamlined structure of one bank account per property. And then you can do your bill pay through us. And then when you do your bill pay through us, you, in the act of paying your bills, you assign that specific bill to a property, you categorize it by expense category, bam, your bookkeeping is done. And then all that feeds into the purpose-built accounting software so that you can set up rules to tag your transactions, right? For a lot of these, the bank statement is the general ledger because it's all cash-based accounting. So we suck in all the third-party transactions. You have the bank transactions from us, set up rules to auto tag, and then you get real-time reporting. You get your P&L, you get your rent roll, you get your T12, you get your cash flow statement. At the end of the year, you get your Schedule E, you get your balance sheet, you get your schedule of CapEx, and it's all there. It's all out of the box. And you can really automate it. And we have customers who are saving 5, 10, even upwards of 20 hours a month by using our software, and we give it all away for free.
Okay,
So
so free's a tough business model. So like, let's talk a little bit more about how the financial and revenue model works for
mhm.
Azibo.
Yeah, no, it's a great question. So we give away all the software for free, and then we have various embedded offerings where we're able to monetize. So take rent collection, for instance. ACH is completely free, free to the landlord, free to the renter. But if the renter wants to pay on card, we
Yeah.
charge a small convenience fee for that. Um, for the Credit Boost product, we offer 2 months free, and then it's $4.99 a month, which is, I think, a great deal considering that you can get up to a 60-point boost on your credit score just by reporting your rent, and think about what 60 points can be worth on a car loan or on a mortgage loan down the road. Massive savings for $4.99 a month. We sell renters insurance. We're a fully licensed P&C insurance agency, so we get the agent commission on that. Again, if the real estate investor requires renters insurance, the renter has the option of buying it through us, or they can bring their own and upload it. We don't require it, but we make it convenient and easy, and then we take the agent commission on that. So there's a whole host of sort of like those types of optional embedded services that provide additional value to the customer, that if they choose to use them, we make our money that way. But we feel like, you know what, the core software offering should be available for free.
Okay, so you're a licensed PNC agent. That makes a lot of sense. We talked a little bit about banking earlier, and you said you have a
Mhm.
bank option. I'm going to make the assumption you don't have a bank charter, but is that a partnership, or are you in fact a bank at the same time?
No, we're not a bank, so that is through a partnership. The
Okay.
underlying bank is Piermont Bank.
Okay.
They have a bank charter. The accounts are fully FDIC insured. And like a lot of other sort of modern fintechs out there, we are the front end, but
Yep.
the underlying bank is Piermont.
Okay, that's really interesting. And then on Credit Boost, and I know our team at HousingWire has covered this pretty extensively. I just don't have all the details in front of me. Accepting rental history is a relatively new addition to
Mhm.
the credit scoring process, correct?
Correct. Yep. It's
Yeah, so
really
what
only taken off, I think, in the last 10 years. And it's really, I mean, like the big increase has been in the last few years.
yeah, I mean, I even in the last year, it's made
Yep.
made like many more headlines. How
Mhm.
important is that credit boost capability to your landlords? And like, are they asking, or do they have like tenants that are like saying, "Hey, I want to make sure like I have like credit reporting for this rental history," or like what's kind of like the demand flow look like there?
Yeah, no, that's a great question. It's certainly something we hear. Like, we've gotten feedback from our landlord customers that beyond sort of the core feature functionality, workflow automation, quality of life improvements we give them, the ability to offer these benefits to their renters is really appealing to them. It makes them stand out in the market. And we've heard that, renters are now increasingly aware of this as an option and they want it. Because, right, like it's an additional
Yeah,
trade line that doesn't require debt. Like most historically, if you wanted to build your credit, you had to go take debt to build your credit. And now you can do it by getting credit for something that you have to pay every month.
that's really interesting. I want to get in and talk about like the broader housing market and the rental market and all the data that you're seeing flow through the platform. But I'm so interested in the business at this stage. I want to dig a little bit deeper. So being such an end-to-end solution for these property owners and investors, what's been like, as a CEO, as an operator, what's been like the hardest part of go to market and like and reaching these real estate owner operators with a free solution? Like what's the hard part of your go to market strategy?
Yeah, I mean, the reality is it sort of sells itself. So the hard part is getting them in the door.
Yeah.
And the challenge there, I think, is similar to how I described Chris, our founding CEO, as like the prototypical customer. He doesn't walk around with like his professional identity being, I'm a real estate investor, right? Like his professional identity is, I work in business, and he's had a variety of jobs.
Yeah.
But at the time, it was like I'm a consultant, or I'm in private equity, or I'm a technology executive, I'm a founder, right? And so for this class of customer, right, of the 8 to 10 million people in the United States, right, they're lawyers, they're doctors, they're dentists, they're contractors, they're engineers, they're product managers, they're whatever, right? They have some other professional identity, and that's who they are. And this part of their sort of financial network is sort of in the background. So how do you go find them, right? That's the challenge.
Do you find like kind of greater adoption and greater appeal with like a younger digital native group of customers, or are you seeing people of kind of all ages, backgrounds, tech skill set want to adopt more tech enabled solutions for property management?
Yeah, I mean it's definitely a broad spectrum, but we are seeing a couple of trends where it's sort of an emerging class with computers who are investing in real estate, or real estate is a large part of their sort of retirement
Yeah.
planning. And they think about like, this should be digital. I shouldn't be doing this with checks.
So there's been this narrative, I think it's kind of started pre-COVID and accelerated a little bit, that you have high earning, high income, high asset folks in expensive markets like San Francisco and New York who might still be renting their primary or don't own in their home market, but want to invest elsewhere in the United States. And like you talked about Chris having properties across in multiple markets. And do you see users that might live in San Francisco but want to invest in Des Moines or Birmingham or areas where the math might pencil out a little bit better on investing in real estate?
If I want to make an investment, and I live in Los Angeles, so I can talk a little about the Los Angeles market, right? Like, price to rent ratios are way out of whack in Los Angeles.
Yeah.
The cap rates are really low. Not a bedroom unit in city of Los Angeles is going to cost, I don't know, $600,000, $700,000. Or you can go to the Midwest, buy a single family home, pull in on this one unit for the same amount of money. I can buy 3, 4 units. And now all of a sudden, all my eggs aren't in one basket. I'm not all dependent upon one tenant. I can diversify a little bit. Or I can actually get in at a lower price point, which means I can actually get in and then buy the next unit, and then buy the next unit over a period of time.
Yeah, it makes a lot of sense. So you talked about how like in LA, there's this mismatch of pricing and rental prices. And I think there's some mismatches across the country. So let's talk about kind of the health and state of the residential housing market overall. So in a lot of the data that you're seeing kind of cross through your platform, are you seeing any indicators as to the health of the rental market or health of housing overall? Like, I'm kind of curious of your take on the state of housing.
Yeah, I mean, that's an interesting question, right? Because like the health of the market so much varies based on like where you sit in the market, right? So
I
like a
love
healthy,
that take. I think that's like everyone says like the housing market's in the shitter. The housing market's great. No, actually, depending on where you sit, it's a completely different equation. But
yeah.
I like that take.
Yeah, like if I'm a renter, then rents going up and a supply constrained market is terrible for me. If I'm an owner, a supply constrained market and rents going up is amazing for me. If I'm an aspiring owner, an investor, then I'm really interested in, all right, like what is the cap rate? What are interest rates doing? And can I actually make a cash flow positive investment today? And so it very much, and that's at like a very high level, right? And then you get into like your geographical nuances. So even today, where mortgage rates are 7%, I mean, there's a house across the street from me offers in 1 week, five of which were 10% plus above asking price. So like certain markets, like city of Los Angeles area, they're just not building much. People still want to live here. So like, is that a healthy market? Well, it is if you own the house. Is that a healthy market? Well, it's not if you're trying to buy
Yep.
the house.
Yep. If you're a first time home buyer,
But I
it's
think
usually rough.
overall, right? Yeah, like unemployment is low. Like there's still pretty decent income growth. So I don't, people talk about recession, people talk about high interest rates. I mean, I think overall, like this isn't a situation in my mind like 2007, 2008, where we're going to
Yeah.
see people who really got in over their skis. I mean, I think like the underlying fundamentals are relatively strong. People still need to live somewhere. Um, I don't think we're going to see sort of like the same scale, at least in the like single family home residential market. Now, there is a lot of talk and a lot of actual real estate debt that's coming due over the next few years. I think, especially if you're in sort of like downtown office buildings with 30% vacancy rates, that's a whole other market, but that's not that I can only tell you what I read in the news. That's not where we play.
Yeah, it's an astute observation. Even talking about the commercial real estate market is not a tight enough term to actually like talk about the health of
Mhm.
commercial real estate. You got to get deeper into office and types of retail and types of multifamily. It's all going to be a
Yep,
totally different stories and trend lines. Altos Research has
for
been
sure. Oh,
covering inventory really closely, and like in the available for sale single family market, inventory has been trending down for several years. And at this kind of the precipice of the end of the spring, beginning of the summer home buying season, we're sitting at record low single family residential inventory. But we have seen a slight uptick, like really slight uptick in available for rent single family rental assets. Are you seeing that in any of your data, or kind of hearing from any of like the operators that you work with? They're either more houses can be coming available for rent, either because there's more inventory being created or there's more inventory that's sitting and not being rented out. So like how do you kind of interpret that data, and do you see that trend in the businesses that you're paying attention to?
yeah. I mean, that's not an area that I feel comfortable commenting on. I don't think
Yeah.
we've seen anything consistent enough for me to be able to say with conviction I have some insight that Aptos doesn't have, or to add on to what they. I think I can say in terms of trends, like another trend that we're seeing that I forgot to mention is among our customer base, so the real estate investors, like their real focus, generally speaking, since it's a trend, but the real focus in this market environment is operations. So it's less about I'm going to go out and buy new homes, I'm going to build my portfolio, I'm going to count on appreciation. It's more, let me take what I have and make sure I'm running that as efficiently as possible. So am I rent optimized? Am I cost optimized? Making sure that they're minimizing vacancy, that they're getting high quality renters in. Obviously, like that's all stuff we can help with. We can make it really easy to run your portfolio, but like that's the trend that we're seeing is like in 2018, 2019, 2020, just appreciation is going nuts. It was let me go buy, let me go buy, let me go buy. I can count on appreciation. It really needs to
Yeah.
pencil. Let me make sure I'm maximizing for cash flow. And then I'm going to go at some point, I'm going to be much more thoughtful and strategic about investing and making sure I'm investing in cash flowing assets.
Yeah, I mean, I think the most astute investors like stayed focused on the net operating income and investing in
Mhm.
cash flowing assets, but markets can get frothy. So you talk about like the clients that Azibo serves, and they're very focused on uh optimizing it at this stage of the market and making sure they're running efficient portfolios and maximizing rents and maximizing cash flow. The institutional investors love to steal the headlines and the conversations about the real estate markets. Do you have a take on kind of how institutionals are behaving similar or differently from the individual and kind of small portfolio investors that you work most closely with?
Yeah, I mean, I think the main difference that we see is the way I think about if I'm an institutional and I have 500 units or 100,000 units or 10,000 units, the way I think about my business or can think about my business is very different, right? Like if I have 10,000 units and I have a vendor coming to me and they're saying, hey, you can offer this thing to your tenants and I'm going to improve your vacancy rate or your occupancy rate, I should say. You're going to improve your occupancy rate from 95% to 95.5%. All right, if I have 10,000 units, I can do the math on what that means to me. If I have 10 units, that doesn't mean anything to me. What does 50 basis points of occupancy mean if I have 10 units? It doesn't mean anything. So it's just like it's a much different way of thinking about things at that different level of scale. And so for our customers, it's I want quality tenants and I want full houses. Like that's what it is. It's less about well, I have 10,000 units, so all right, like what is the elasticity of rent? And if I increase rents by $50, then all right, maybe my occupancy goes down by 50 basis points, but net, that's an increase in my NOI. Like none of that stuff works when you have 5 units or 10 units. So that's the big difference we see in how people think about their businesses. So when you see a lot of headlines about prop tech and financial services and what that enables institutional investors to do, like that math only really works when you're at scale. And
Yeah.
so it's just a fundamentally different way of thinking about running your business.
All right, so half a point higher in occupancy might not help somebody who owns 10 units, but I think rent growth can be a benefit to the 10 unit investor just as much as it can the 10,000 unit investor. We've also seen in Altos research that there's been a reacceleration in rents kind of since the start of the year. There seemed to be some softness in our rental data in the second half of 2022. And now we see this reacceleration coming through at a national level. Obviously, every market behaves a little bit differently, but at a national level, a reacceleration. What are you seeing inside of the investors that you work with and the homes that you track from a rent growth perspective?
Yeah, I mean, I think this comes back to sort of the trend I was seeing. We were talking about earlier about sort of people focusing on optimization
Yeah.
and where there's an opportunity to take rent growth. Like I think people are jumping on it now. Um, I think overall across the data that we've seen, like we haven't really seen average rents change in any material way. But sort of anecdotally, what we're hearing is where there's an opportunity to take rent growth, people are taking rent growth. Now, again, getting back to the difference between our typical customer and an institutional customer, right? For our customers, um, occupancy is generally more important than optimizing rents because they can't spread, right? Again, like to go back to that like price elasticity, like elasticity math works at scale, doesn't quite work at 5 units or 10 units. And since a lot of these folks are doing this as a side job, so to speak, like there's a price to pay for peace of mind.
Yeah.
And so giving up $20 or $50 a month of rent in order to have a really high quality tenant who's going to be in there for 2 or 3 years and is going to treat your property with care and is not going to call you every day, like that may be worth those few extra dollars. Because again, they're also not doing the math. I mean, for a lot of SFRs, you can't do the math of, all right, an increase in my NOI of X divided by a cap rate of Y means an increase in appreciation of Z. And then I can go refi that out and like that doesn't really
Yeah.
work at the SFR level. So like all that kind of really like financial engineering in the weeds, like forced appreciation stuff that works really well for large institutionals doesn't necessarily always make sense for the sort of like independent real estate investor.
Yeah, it's kind of going back to the topic of office, and that was kind of the office strategy for years. We'll see if that holds. Is you'd rather have a full price tenant in at the right time, even if it takes months or years to get them
Mhm,
there, because that's how you're going to maximize NOI for ultimate refinance or
mhm,
asset
mhm.
sale. Where if you're building a 10, 20, 50,000 unit SFR portfolio, it's a different game. You're trying to build long-term wealth, long-term cash flow for your
Mhm.
family, not recap and sell
Yeah,
ASAP. So
yeah.
totally
Now
different
there are
strategy.
people in our customer base who take the more like recap, sell, turnover, do deals. Like there is a class of folks who are not necessarily institutional, but are on the higher end of independent who do this kind of stuff. But no, like your typical independent real estate investor is I have 10 units, 15, 20 units. I want consistent cash flows. This is going to be an asset in a portfolio that I'm going to keep over 30, 40, 50
Yeah.
years, pass it down, and just have sort of generational wealth building.
So at Azibo, since you are seeing financial transactions from tenants, can you speak at all to kind of the health of the renter and any trends that you're seeing in terms of payments, on time, delinquents? Like, what are you seeing in the data that kind of helps us better understand the health of the renter?
Yeah. So as I mentioned, I talked about the credit boost product. We've seen a much more interest in that product increasing over the last year. And I think that's probably driven by both sort of like the interest rate environment that we're in, but also tightening credit conditions,
Yeah.
where is 3, 4 years ago, right, there was a wide availability of sort of subprime credit. You could go buy a car, you could go buy a motorcycle, you can refinance. Like now, like you may not be able to get a loan. Uh, Setting aside the price, you may not be able to get one. So I think, and then also, I think there's a much, people think much differently about like interest rate optimization and what their credit score can mean when you're thinking about like 8 versus 12% than when you're talking about, like 3 versus 4%. So that's one trend that we're seeing. Um, we're seeing, I think, so far across the entire spectrum, like relatively consistent amounts of payments being going on card. There's some fluctuation, but we haven't seen like a dramatic uptick, I think, in the number of renters who are putting their payments on credit card, which could be a sign of distress. And likewise, in terms of like late and the percentage of people who are late, overall, we haven't seen any like major changes in that metric that we track on a monthly basis. But I think the credit piece is the one that's the most interesting to me, and seeing that, hey, at this point in any like cohort of tenants who are signing up, we're up to like 15 to 18% of people signing up for this product, which is significantly higher than it was 6 to 9 months ago. And I think there's just like a bigger awareness of like this is something that's, again, like in a 5% interest rate world versus a 2 or a 0%
Yeah.
interest rate world, like it's just much more important.
I mean, I have to kind of take that read and also wonder if low housing inventory and high home price appreciation may have more potential home buyers on the sideline in the rental market, working on improving their credit, working on getting their financial life in order to, to not be kind of sidelined homeowners at some point.
Mhm.
And I don't want to imply that every renter is someone who's going to enter the homeownership market, but it is a conversation that we hear day in and day out from the real estate agents, brokers, and lenders that we talk to about kind of their pent up demand.
Yeah. No, I think especially in certain markets where there's just not a lot of inventory. And then again, like you have this whole this whole vintage of home buyers or refires who are sitting on what, like sub 3% or sub 3.5% mortgages, and they got the golden handcuffs. Like they're not going to move. So like that's a lot of inventory that's not turning over.
I
So a
won't
lot of
sick our
interesting
lead
dynamics.
analyst Logan Motoshami on you. Logan is a diehard non-believer in the interest rate lockdown theory. We debate internally quite often if that actually exists or not. Uh, but,
I mean, I
look,
mean, I think it's one thing if you're talking about like, well, I bought at 3.5 and now it's 4. But if you're like, I'm at 2.5 and now it's 7, I mean that like you get half the house,
dude,
right?
because I'm in the lockdown camp. Like I've got a interest rate with a 2 handle on it, and it didn't take a lot to make me want to leave that mortgage product, especially for something that would probably lock at 7% today.
Yeah.
Yeah, no, that's I understand the lockdown camp. Logan's take is that he's very data centric, right? And like the
Hmm.
Logan's take is historically the lockdown handcuffs get broken really quickly as soon as people date, mate, and need more space.
Fair enough. Well, I
Yeah.
guess in general, we've also seen right over the last 20 or 30 years, like interstate mobility has gone down. So, what is the actual like trend, and what are the macro trends, and how much of it is interest rate versus just sort of like general people aren't moving as much as they used to.
All right. Awesome. Vikas, thanks for giving us a glimpse into Azibo, the story, and some of the data that you see through your business and time leading a technology company in the rental market. Really cool to learn more about Azibo.
No, thank you. This has been a really fun conversation.
Hey, and before we go, I have to also drop that you are also a podcast host. You have a new show. I was listening to a few episodes. You're 8 episodes in.
Hmm.
What's been the most surprising part of hosting a podcast for you? Like, we did like the CEO to CEO conversation. Now let's do the podcast host to podcast host conversation. What's been the most kind of surprising part of hosting a show for you?
Yeah, I mean, I think the most surprising part of hosting a show has been, I think the sort of accessibility it gives you. I mean, it's a great way to enter a conversation with folks. And now we have people approaching us saying, "Hey, can I be a guest on your podcast?" Just like it's a great door opener. I think that's one. I think the second part is I didn't realize how much fun it would be. It's just so much fun. Like I love these conversations. I'm learning so much. Um, and I'm meeting so many cool people and I'm hearing so many interesting stories. And I think like the one big thing that I've learned or not learned, but it's become really clear to me from the 8 conversations I've had is like there is no one right way to invest in real estate. Because we have one guest who talks about I'm all in one market and my competitive advantage is I know this market cold. And
Yep.
then the next guest is like I'm in 15 markets and I just want the right deal. If the deal pencils, I want that deal. And I believe in geographic diversification anyways. And then we have another person who's like, I want really high quality properties and really high quality tenants. And we get another person who's like, I buy B and C class properties and I make my money by rehabbing them and driving forced appreciation. It's like they're all very valid strategies. I think the key thing and the key takeaway that I've learned is like as long as you have alignment between like what you're looking for, what your capital uh, capabilities are, what your risk tolerance is, all that drives between that, your strategy, and then how you execute. As long as that's in alignment,
Yep.
you're in good shape. But that can look very different for a whole wide range of people.
That's a fascinating observation. I'm excited to listen to more episodes and hear some of these stories. For folks that haven't listened yet, it's called Hacking Real Estate. I found it on Apple Podcast. Same place you can find housing news. Vikas, thank you so much.
Thank you, Clayton. Take care.